Welcome to the ProfitLed podcast, where we discover proven growth strategies for bootstrapped entrepreneurs from the people who have done it before to help you accelerate your business. The ProfitLed podcast is brought to you by eWebinar, the leading automated webinar platform, which could save you from doing the same webinar over and over again. From sales demos to onboarding to training, eWebinar turns any video into an interactive webinar that you can set on a recurring schedule or make available on demand, which means you can do hundreds of webinars without ever needing to actually be there to host them live. This podcast is a forum for the unsung heroes of SaaS, the founders and others behind bootstrapped startups who are creative and resourceful enough to forge a pathway to success. Here is where they get to share everything they learned along the way, so you can benefit from their experience and find success in your own ventures too.
Welcome to ProfitLed, the podcast for bootstrap entrepreneurs looking to make it happen. My name is Melissa Kwan. I'm the co-founder and CEO of eWebinar and your host. Today's guest is one of the most active advocates for bootstrap founders, or practical founders, as he calls it, serious startup founders who are building software companies without big funding. I'm here with Greg Head, the founder of Scaling Point, a startup consultancy, gregslist.com, which is a curated list of local software companies in 8 different cities, and Practical Founders, a top business podcast, and a founder community. I'm excited to dive into his background and experiences today because he's usually the one doing the interviewing for his podcast, and his opinions around bootstrapping versus venture capital. And more importantly, we'll be talking about the things they don't tell you about raising VC. So if that's a funding path that you're considering, you'll know what to think before making that decision. Hey, Greg, how's it going?
It's going great. I'm actually in Park City, Utah, at our second home up here in the mountains in snow and ski country. So I'm actually moving around a little bit like you, Melissa, and enjoying life in between, working all the same.
Awesome. Well, I'm a big advocate for digital nomading, being in Hong Kong myself right now. Well, thanks so much for coming on the podcast. Which drink did you bring with you today?
Well, since we're on opposite sides of the world and it's morning here in the U.S., I've got my favorite kickstart, which is an Americano, an espresso with water, coffee drink.
Do you put anything in it?
I don't. I'm kind of a purist, and I don't know. It's just kind of a hardcore practical thing. It's just inconvenient to get addicted to special creams and sugars and all that kind of stuff. Let's just mainline it and all of that. So you actually do espresso shots in the afternoon, but in the morning I add water, and it makes a more strong but balanced coffee. It's less bitter than a normal coffee that you would get at Starbucks.
Do you have one of those fancy machines that you make it out of, or do you just do the Nespresso?
I do.
So it's like a ritual.
Yeah.
Awesome. Well,
yeah.
I have this green cream soda. Have you ever seen this?
I have not. Green cream soda.
Yeah. So it tastes like childhood. It's something that we grew up with in Hong Kong. I actually, because of this podcast and because this is what I got, and I can only get it in this part of the world, I Googled the origins of it, but I couldn't find it. So this tastes significantly different than any of like the pink stuff that you see in, the US and Canada. It actually has it's actually creamy, like it tastes creamy, and it's got like a vanilla hint to it. So I'm going to open my drink now, since you already have yours in your hand. So it's time for some ASMR magic over here.
Oh,
and
that was
great. Of
great.
course, if you're at home, you can join us as well. I've got a glass to pour it in.
That's like a TV commercial.
At night.
Yeah.
Yeah, it's 11 at night, so it's a great time to be drinking lots of sugar. Well, cheers.
Yeah. Cheers.
Just like
we're hanging out. Love it. Yeah.
Well, Greg, we've talked a couple of times now, but every time it's just me doing all the talking and never the other way around. So I realize I don't know much about you, but I did read your story on your site about how you got into software through, selling floppy disks at a retail store, which is a blast from the past, which I want to include in the show notes as well. And I know you have a marketing background, worked with Infusionsoft as their CMO for 5 years before becoming a consultant and mentor for a bunch of startups. Can you tell us more about your story and what led you into the startup world?
Well, I have to take a deep breath because I'm a bit older and I have a long story. So my story starts, I'm from Chicago. Let's see if I could do the compressed version here. I'm from Chicago and I went to the University of Iowa, studied economics, Spanish, the rest. Came back in 1987, that long ago, to Chicago and looking for a real job and put on a suit and didn't feel it. And this is before startups and software and venture capital and all of that stuff. But a buddy of mine said, hey, why don't you work with me while you're looking for a real job at the software retail store? Software was in boxes with disks back then, packaged software. And it was a totally new thing. It was this newfangled thing for the geeks. And the software store was called Egghead Software. So I started working there with a suit on and a name tag and helping people buy spreadsheets, Lotus 123, and doing all that stuff. It turned out to be one of the fastest growing companies in the US, finally went public. They were there at the beginning of the software business. And so that was my bit of luck. I worked for Egghead Software. So I was literally Greg Head from Egghead when I got started. And I managed stores and, they were selling half the packaged software in the country. So part of my advantage is I started early before markets were big and doing all that kind of thing. And so if you're late, it's a totally different game. But that was my thing. I wasn't intentional about getting into startups. I joined a software company after that, which was the first contact management software that was popular for salespeople and entrepreneurs to manage their contacts on their PCs. And this was pre-Windows, it was DOS and all that kind of thing. So I wasn't intentional about being startups. Startups were definitely not cool. Entrepreneurship, home office, startup really wasn't even a word. Venture capital wasn't a thing other than like a pocket of Silicon Valley. And for, the first 10 years of my career in software, everybody was saying, when are you going to get a real job? Because people aren't going to use computers. Salespeople aren't going to use computers. I ended up in the CRM industry. It wasn't called CRM in the beginning. It was called contact management. And I was a co-founder of a sales automation, then CRM company after Act Software, the contact management software. And we grew that up. So I grew a little scrappy software company up, helped to grow it as product manager in the early 90s. And we sold that to Symantec, and I lived out in Silicon Valley. And then with the co-founder of Act, we started SalesLogix, grew CRM. We actually bought Act back from Symantec and ran it alongside SalesLogix. And then we went SalesLogix in the CRM industry, kind of mid-market in between individual users and big corporates. We grew from let's do this around the kitchen table to 500 employees in a public company in 5 years. So those were the days. And we had venture capital back then. So that speak that language as a first language. So by year 2000 and 2001, there was a boom and a bust around that. Startups and software and everything else was cool. And it kept growing. So I did Act and SalesLogix. We sold that company, Act and SalesLogix for 15 years, and then did a lot of consulting and joined Infusionsoft, which is now called Keep, K-E-A-P. So I helped grow two software companies in Phoenix to $100 million in revenues, which was kind of the marker back then. If you raise venture capital, $100 million is when you start to go public in the old days. So I'm old enough to remember what it was before it was cool, when it was packaged software, when B2B software started, when the booms happened and the busts happened in 2008 and 2009 and SaaS. So I've been playing the game in all these generations. And there's laws of nature that haven't changed, whether you're funded or unfunded or 20 years ago or 2 years from now. And there's things that have changed. So distinguishing those is the most useful thing. I mean, one of the things that has changed, by the way, you don't need to raise big money to make software. You can make software cheaply. You can go to market cheaply. And you can run it forever or, sell it before it gets to $100 million. Those didn't really exist 5 years ago. So I think that enabled what I'm talking about now, which is the practical founder world. There's a swim lane for VC funding, but it's really for a small minority of software companies. And most founders who are desperate for funding and playing the margin in the ecosystem don't even know what the game they're playing these days. So it's different than it was 20 or 30 years ago when you kind of needed to raise VC money and there was big open markets and you played the game. So I've been playing that game for a long time. Now there's so many other ways to do it. And everybody's saying VC funding is the only answer. And without knowing exactly the game you're playing when you raise money like that, it's usually very treacherous for founders. And I've seen this. I talk to 500 to 1,000 founders a year. And I've done the longevity study. I've seen the pain and suffering as you have, and the wins and the life and the success when you do it without big funding.
I mean, I can imagine, I never thought about it that way, but I can imagine how expensive it used to be to build a company. I mean, right now it can't be cheaper, right? And it only gets cheaper.
Yeah.
But
right.
Your company is more than your product, right? It's so much more than that nowadays because the product itself has been commoditized, right? So what
Yeah.
was your experience with running a VC funded company in the past that ultimately gave you the perspective that you have now?
Well, I'm here in Park City, Utah. We have a second home, and that is actually part of the prize winnings from my first real experience with VC funding with SalesLogix in the late 90s. We raised about $27 million worth of VC funding. We grew fast. And this was a wide open market. Salespeople didn't have computers. Someday they'll have computers. We're all racing to start this a new market that's now called CRM. So we actually succeeded in that game. We grew faster than the VCs thought we would, and we were kind of practical about it. We started in Arizona, and we went public in 99 when everything was heated up, and we sold it in 2001 when it was cooling off, and there was some prize winnings out of it. I can't tell you if I ever did anything other than my family. I was having kids at the time. My wife was home, fortunately. I was traveling the world. I was working all the time. I was all in. This was the game. Old school, all in. And, even different than today's VC experience. But, another decade in the 20 teens with SaaS businesses that are now easier to create with AWS and full stack and lots of tools and everything else, and a different way to reach customers with organic social content and other ways to reach customers efficiently. With Infusionsoft, we raised $100 million to grow from $15 million to $100 million. And I was part of that. I've been all over Silicon Valley and Sand Hill Road to raise money, been in the rooms for all that conversation, pitching that. I've coached thousands of entrepreneurs on pitching that. And then Infusionsoft stopped growing. They really hadn't invested in their product. They invested in the growth, but not the product. And then that caught up with them. One of the most painful things to experience, and people can hear this now, we all friends, is a VC-funded company that doesn't grow to expectations, which is almost like doubling every year. Doubling is the new tripling in this year, 2022. It is really, really painful. You can't raise the next round. You got a gun to your head. The decisions you need to make to solve the problem you can't really make. You're stuck. You're laying off employees. You're turning over teams. It's actually really, really frustrating and very bad. So I spent 5 years growing it, and from 15 to 100 million. I was the CMO. So I've done product. I've run software companies. I've done everything in the software business except code. But these days, we all know the VC-funded friends who are trapped. They can't grow faster. They can't raise more money. In some sense, they can't sell it because they raised at such a high valuation and now they're not meeting that, so forth. So you literally have to be the exception, keep growing at 2 to 3 times a year in the early stages, or, the trapdoor comes and you're in the pit of snakes. It's really painful. And, you can choose that, but the first rule of the game is to know what game you're playing. And most funded founders these days aren't really clear about the all or nothing game that happens when you raise big VC funding.
And I know your point of view is not no funding ever, right? Very, very few founders have zero funding. Like even for us, myself and my co-founder invested our own capital. And then of course we have sweat equity from not paying ourselves. We have friends and family funding to get the company off the ground. I mean, it just wouldn't have been possible otherwise. But there are just different types of funding for different types of businesses, or maybe even the life that you want to live. So can you share more about your thoughts on this particular topic?
Yeah, I think, Melissa, there's always funding. You've got to create something, and then you've got to build something and sell something. And revenues don't happen before you do it.
So rare. Like your podcast on Kajabi, I think the Kajabi founder was one of the very few I've ever heard that actually did it. Zero funding. Like I think it was like $1 million ARR kind of right out of the gates, but that is like such an exception.
Yeah. And the funding, let's call it. I mean, the founder coded in his spare time. He had a day job and coded in his spare time and built something and then developed the relationships with these huge influencers, powered their platform. All of a sudden, millions of people had seen this new thing on the platform and they were, lining up to buy it on day one. But so he invested his time. And there's always an investment there. I think one of the things that drives me crazy the most is new, ambitious, smart, capable, but naive founders who are saying, I've got an idea, I need funding, right? before they've invested the time, some savings, the rest. By the way, my Greg's List project, which is 6,000 software companies, gregslist.com, I've been doing kind of a longevity study on the entire software ecosystem in 8 cities, and it's still growing for 6 years. And I can see that half of the software companies in any town don't have outside funding. 20% of the software companies in Dallas or Austin or Boston or Phoenix have institutional VC funding, and the rest have something in between. So how you fund getting it up and running is really kind of the magic trick. And it takes work and effort. So people say, well, that sounds hard. Not quit your day job. I say that a lot. Or, in a service business, there's a lot of people that have built a profitable service business and use the team and the profits to fund a product out of that and do that transition thing. That's very common. A little friends and family. And all of these things are useful ways to get going before customer revenue funds your business. But it's very different than VC funding, where you're pitching and you're selling to very experienced and very powerful investors. They have all the leverage, and you get these preferred shares and liquidation preferences. And I don't think people are aware in the States when they're in the ecosystem, Safe Note is like the gateway drug to this big funding. I'm just going to get a Safe Note.
Yes.
But a Safe Note converts into equity funding, and then you're on the Series ABC escalator. And if you don't go all the way through the escalator, and win at every stage, it's like being in the World Cup and winning at every single stage, which doesn't happen to everybody, mostly doesn't happen. You're actually going to lose the value of the company. The founders walk away with nothing. 50% of VC-funded software companies, the founders walk away with nothing. So it's kind of an all or nothing bet. So people don't know that. They don't hear that.
Let's dive into that a little bit, right? Because VC money is obviously attractive, right? Getting millions of dollars at once. It seems like something that could be
sexy.
the end to all your problems. I personally also fell into that trap, especially because I moved from Vancouver to New York. All my peers are talking about raising money, and I was struggling. And they were all asking me who I was raising from, who do I want to pitch, who do I want an intro from, as if that's what I needed to do, right? And and I had been struggling for years up to that point. So this VC thing, seem really attractive. But most people, as you said, don't realize that taking VC funding is the beginning of a new journey with their startup. And I talked about this experience a little bit in the first episode of this podcast, but can you share more about what they don't tell you about VC funding? I know you mentioned liquidation preferences and all those. What are all those things? And what would you warn, founders about if they're going on this path?
Yeah. And these are things, by the way, that would not be, no VC would argue with me. It's the game. They know what game they're playing. They're perfectly clear about it. It's literally in their documents about how they fund this thing and what their math is and so forth. So they're clear about it. And new founders generally are not. So when I talk to a founder and they're capable and have got a good idea and they're maybe underway, and then they say, I need to raise some funding. Can you help me raise or whatever? I start asking questions like, what kind of VC are you looking for? And, do you know that a Safe Note, Series A, B, C, D, and most don't know the answer to it, which is like signing up. It's a little bit of an opioid crisis in the modern era. It's just so overcooked and so overprescribed and so misunderstood. And it just seems as, there's people are just stepping into this thing without knowing what the game is. The first thing that founders ought to know is that raising capital is not easy. And it just got harder from 2021 to 2022 as everybody's more rational this year. Most founders will say it took a year to raise my first round of funding, as almost a full-time job. And so when founders can hear that, they say, boy, I should probably just build product and go sell customers, faster instead, and getting there. But if people don't know it takes that long, it's like you just don't walk up, push the button, and you get VC funding. Even in Silicon Valley last year, where things were so crazy, people getting big money on just a pitch deck and things like that, that's kind of rationalized. Outside of Silicon Valley, it's normal. We wait to see if there's revenue. I'm actually an investor these days. I invest in angel funding and all that, not the big funding game. So the first thing is raising money is hard, and you actually need to show revenue and customer traction to raise money in the modern world, unless you are a celebrity, third-time made founder that paid back investors, right, that has investors following them around throwing money at them. For 99.9% of founders, you actually have to get to 20K, 50K revenue in SaaS, monthly recurring revenue, to show that there's a there. Very few investors are, here's another thing, very few investors are investing in pre-revenue companies. It's like almost none. So the ones who are going to invest in you, I don't have revenue, but I need to get funding to get to customers and revenue. Those are friends and family and people who believe in you. VCs are waiting to show proof of the business. So you say to a VC, Michelle, I remember it was Spacio, but like if you said with eWebinar, we've got this platform, and instead of doing a webinar manually, you can automate most of it, and it's a better experience overall, and saves all that. What do they know? Okay, I don't know. Will people buy this? I don't know. They wait to see if there's traction. This is the traction thing. So that's another thing, is that if you actually want to raise money, you actually have to show revenue, customers using it, paying you, liking it, and a growth rate that makes sense. So those are a few things. I'll keep going if you want. I'll just keep going down the food chain. Another thing is, if you get to 25K recurring revenue, maybe somebody pays you $1,000 a month in US, and you have 25 customers, and that's a big milestone. That's actually underway as a company. It's not product market fit, but it's underway as a company. If you don't double that number every year, like 100% growth or more, or 15% growth a month or something like that, the maths will, if you raise funding, it'll kill you. You can't raise your next round, and then you're stuck. So if you raise a seed round, then a seed round, raise $1 million from some institutional investors because I got the 50K MRR. If you don't grow fast enough, it's about the revenue. If you don't grow fast enough, you don't get to raise the Series A. Then you're stuck, right? So you're kind of they call them zombie startup, zombie companies. If you don't get to raise your next round, which is the majority of companies, and VCs know this, and founders don't, you're kind of stuck. You can't raise more money because you're not hitting your growth objectives, and your previous investors aren't investing, and it's a really crappy game. So you kind of built the business to burn money and spend more than you make, and all of a sudden, you don't get any more funding drugs to keep the game going. I think there's an argument to be made for the pie. When you win the game, you get to $1 billion valuation faster than if you didn't. And what people don't hear is that if you raise that seed, Series A, Series B, Series D, like the Silicon Valley March, right? Consecutive rounds of bigger funding as you grow. When you go public, like an Airbnb or something like that, most of the founders, they don't own most of the company. And on average, a software company that raises venture capital goes public, on average, the founders and their teams, all the employees, have 15 to 20% of the business left over.
Yeah.
So,
and that's founders combined.
Yeah.
Like say you have two founders.
Yeah, totally. So you actually have to grow about 10 times bigger, 10 times faster to make the same number as a founder.
And you're also inviting someone onto your board who now has a say in what you do and you don't do. And also, preferences on who gets paid out when, right? Who gets paid out first.
Well, let's talk about both of those. The first thing is your VC becomes a third customer in your business. And actually, of the three customers, your employees, contractors whom you serve, and there's a relationship, your funding partners become your first customer. It's the most important customer now. And you just inherited the business model of your VCs, which is you need to grow at this pace so we can get our investors paid back and sell the company. When you take funding of a certain size, you've said, someday I'm going to sell the company. The race is on. You all of a sudden now have it's like the parents moved in and they're telling you what to do. Don't put that there. Don't do this. Like, that's exactly what happens. If you get serious funding, they're not like, yeah, just do what you want and keep us posted. If you raise serious funding, we're having monthly calls and every dial is measured and monitored. And if the growth isn't there, you got to whip the horse to solve the problem. You got to fire your co-founder. You got to ship the product. You got to do. Sometimes the game works, and it's just the VC game works when there's a big market. Founders know exactly what's going on. There's traction and momentum. And the funding is just fuel to accelerate. It's not desperate. We're running out of money. I need funding. That's just a setup for the founder. It's, we're growing. We need to grow a little bit faster or a lot faster, and we're going to raise money. which we don't hear that very often, but that's actually when the VC game works for founders. The last thing is when you sell a piece of your company to institutional investors with a fund, VCs of all types. There's several types of VCs. They don't just get common shares like the founders have and the employees have. They get preferred shares. And preferred shares means there's all kinds of qualifications that come in there, and we'll let you sell the company or we won't let you sell the company at a certain price. That's one of the preferences. Another one is the liquidation preference. If you get a stalled company and you say, this isn't going to grow to be $1 billion company, somebody made an offer for $50 million, but the VCs invested at a $50 million valuation. They got $10 million on a $50 million valuation, right? So selling at $50 million is like it's not even break even for them. The liquidation preferences mean that they get paid out before the founders do, maybe 2 times or sometimes 3 times or sometimes more. So if you stall and you sell your company for not the big 10x valuation, investors get a way bigger cut, a multiple cut compared to their investment, their liquidation preference, and founders usually end up with nothing. It's kind of a wash. So mostly of all the VC funded, all the clapping we see, all the ecosystem energy and everybody just, funneling everybody into the big funding game, how much you're going to raise and the pitch competitions and incubators and accelerators, just aiming towards funding and the rest. 20% of VC funded founders actually make out great. 50% walk away with nothing. 20%, the other 30% kind of are like, it was pretty good. It was okay. We got out with the skin of our teeth kind of thing.
Could you even imagine working so many years and then having an investor say, I'm not signing off on that deal? Like you have to keep going.
It happens all the time. Yeah, keep going. Rip the horse and keep changing and doing the things. And at that point, it turns into some unnatural acts. Like what I appreciate, because I talk to founders and I'm doing this longevity study, is that the VC funded companies, the big wins we see, we're not hearing about the losses for founders. We know there's no clapping. People aren't talking about it very often, but that's the predominant case for VCs. Now there's this growing, it's quite large, like as many companies as are VC funded, that I call practically funded or bootstrapped, software companies that don't have big funding, where they could do what's right for the customer. They can do what's right for the employees. If you create a successful business and you do what's right for the founders, you can live the life you want and things like that. You don't get those tickets, generally speaking, when it's VC funded. When I see a company that grew to a 5-10 million revenue, which is a substantial software company, and then they get big VC funding, I know, the drugs are on, the venture begins, it's go big or go home. It's an all or nothing binary outcome for the founder. It's not a binary outcome for the VC because they invest in dozens of these and they know half of them aren't going to fail. So they just play their odds. The house always wins in that regard. They're literally playing for the 1 out of 10 that's the big win. And that's how the math works in the fund. And they're not arguing that. It's not a bad thing. It's just about, any founder that says, I'm going to go raise money that is more than just angel friends and family, they have to be aware of all of these things and have to be able to create a business that grows fast enough and sells big enough to stay ahead of all the alligators that are coming to get you if it doesn't happen.
I remember 2 months after we put the product on the market, we did a product hunt launch. We were top 3. Next day, I get calls, emails from VCs because they're looking at the leaderboards. And one of these guys
they're following traction.
Yeah, one of these guys were like, "Oh yeah, like we think what you're doing is amazing. We fund super early companies. Seems like you're a good fit." And I'm like, "Okay, well, how many times do you need to refund? Do you need to return your fund?" They said, 3 times. And I'm like, "Oh, okay, I think I can do 3 times." And they're like, "Oh no, like you still have to sell for $1 billion. I want to return 3 times, but that's just how the math works." And I'm like, "Oh, okay, yeah." Immediately, like that's just not what I'm willing to do.
Let's explain that because I think, I can say a few things to founders and they say, "Oh, I didn't know that's the game I was playing. I think I'll not quit my day job. I think I'll get to revenue. I'll try to stay off the drugs as long as possible and procrastinate funding."
Hey, I'd like to take a second here to talk about my own company, eWebinar, and our mission to rescue people from what I call webinar hell, to give them back their time and save them literally hundreds of hours every month through webinar automation. If your sales team is tired of doing the same demo over and over for unqualified leads or worse, prospects who don't even show up, An on-demand demo powered by eWebinar can help them get their time back so they can close more deals. If you're doing customer onboarding and training on repeat, eWebinar can help you automate those so you never have to do them live again. Customer success teams are using eWebinar to run hundreds of sessions every single month without a live host. Why don't you give our product a try and see for yourself? Visit ewebinar.com to join our own on-demand demo or to sign up for a free trial. All right, now that I've gotten that on my system, let's get back to the episode.
A VC fund, we raise 50 million, 500 million, whatever it is. And we have a fund and we're investing in companies and we're cool and we call on people and we're blessed. We bless them with our coolness. We're calling you because we have a fund and we like to invest. They have promised their investors who built that $50 million fund, funded, they're now their customers. They have promised them, we'll return in 5 to 10 years 3 times what you put in, which is better than what you could do in the stock market. That's their game. So 3 times is a pretty good. I mean, it's a very good fund. 3 times, if everybody could do 3 times, in their 5 to 10 years, that's an above average VC fund. Okay, but the math that I told you is they invest in 20 companies. They know that 10 are going to go to zeros. Once, all this clapping for funding doesn't mean they're going to win, right? But the fund works when 10 go to 0, 7 kind of cover their bet maybe, and 2 are good outcomes, 5x, and 1 is 50x, right? We invested $1 million on it, sells for $1 billion, something like that. And then they get their 3x. It's a blended return kind of thing.
Yeah.
And that's why they're looking at you saying, can you minimum return from our investment value to when we sell it within this time period, a 10x kind of on average? They're not going to invest in you if you can't make that argument. And some can make that argument, but most shouldn't and can't. And VC funding used to be the exception. We know what game we're playing. We're going to play this game. We're going to do it. We're going to go. We know what the stair step is. We know what the end result is. We have enough leverage so the VCs don't really control everything. But now it just looks like the rule. It's just what you do. Every university, every accelerator, every incubator, all the clapping, all the media, which, by the way, is bought and paid for by your
VCs.
equity, the VC industrial complex, right? That's where the money is. Isn't it interesting? We're not hearing about all the bootstrap founders that are making these, huge outcomes and creating very successful companies because there's no money in it for the media. There's no money in it for the VCs.
Oh, I can't get someone to respond.
Ecosystem. Yeah. Right. So it's kind of uncool. And isn't that interesting? So, Melissa, my last thing is the VC industrial complex, and everybody's getting VC money and all this money, so much money these days being invested, and these big wins in public companies. And we can see some of the air coming out of the balloon in 2022 compared to the overinflated 2021. But all these VC funded companies that succeed even and get to an exit and pay back investors, and the founders make a prize and they get to, and they, wave on social media. But that's really the exception. And they walk away with maybe 20% of their company for some of the founders. If they're really lucky, they can get more and they've played the game right. But most walk away with 5 or 10% of the company as a founder. That amount of founders that founders have made by selling their VC funded companies is, I believe, smaller than the total amount that is made by practical founders who did it without institutional funding. And because there's literally 20 times more founders who are growing their companies to 3 million ARR, 5 million ARR, 10 million ARR, 20 million ARR, and selling it for the multiples of 5 or 10 or more, and walking away with all of the prize.
Yeah.
You hear what I'm saying? 20 times more than are winning big prizes.
I mean, in order to have 5 million as a founder, if I'm bootstrapped with one other co-founder, I would have to sell this for, 10 million, 11 million, depending what the split is. But if I were a VC funded company and I have 10% of the company, I would have to sell it for at least 50, right? Or, if I have 5%, then 100. I mean, just because you have an ARR of 10 million does not mean someone's going to write you a check for 100. It's so hard to find someone to buy your company, right? We all talk about multiples and things like that, but there's only so many people that are going to write you this gigantic check, right? But many other companies could write you a check for 10 million, 15 million, right? Maybe a fund, maybe a competitor, right? There's just a lot more buyers because they can buy you for a lot less.
Right. And so you can see that if you say, I'm going to create a 5 million ARR business, which like Melissa, that would be an amazing business with eWebinar, right? 5 million.
Yeah.
Very profitable and lots of
I
customers,
pay myself a great
lots
salary.
of impact, millions of webinars and, hours saved and everything and impact made. VC can't invest in that. That's not like, it's just not big enough. The numbers aren't there. That's why they throw rocks and look down at lifestyle businesses or, oh, it's too niche, you got to go big. I need a bigger TAM, they say, right? The whole thing. So it's kind of ironic. Now, I'm not against VC funding. Like VCs are not arguing with me. Literally, it's the founders who say, but I need funding. But they should fund me before I have revenues. Well, if VCs are a customer and you don't even know what they want as a customer, then you shouldn't be selling that. It's a trap.
Yeah.
And I've seen plenty of founders go through that, and I've lived through that.
Well, you've had thousands of conversations now with founders over the years, different stages. What would you say are the unique attributes of practical founders? And what are some things you've learned from them that all of us can emulate? Yeah,
I feel like I'm the medical doctor that was in the hospital system in the U.S., the healthcare industrial complex. It's owned by insurance, and it's all about the money. And everybody's overprescribing drugs, and people are walking up the customers are walking up expecting an easy answer. Just give me the pill, and it's all kind of overcooked, so forth. I feel like I'm over the last 7 years converted into a more holistic doctor that can prescribe occasionally for the right reasons, do surgery, but like stay off the drugs. I mean, if you just ate right and exercised and you wouldn't have to use all these pills. Literally half of the mega money spent on healthcare in the United States would go away if everybody just ate right and exercised and, got ahead of themselves. So I've been learning from the thousands of founders I'm talking to, literally saying 10 years ago, VC funding, I don't understand what else you would play. And now dozens and dozens and dozens of my friends walking away with bigger prizes than all the VC funding guys. So when I talk to founders, and I have this conversation all the time, everybody needs funding. It's all hard. It's really hard to grow a software company that's customers love and it's valuable and momentum and so forth. But let's see, a few things that I'm saying. Practical founders are saying things like, I'm not going to quit my day job. I'm going to build something in my spare time. I created this company, so now I can build this company like you did, much more efficiently. They're doing the work. And they're very savvy about the details of a business. In order to be a practical founder and do it without the big VC funding drugs, you actually have to be really good about product market fit and really good about spending and really good about all your SaaS metrics and your churn and all of that. You can't have a messy, leaky bucket when you're doing that. So practical founders tend to be well above average in their understanding of their customer, their business, their product, their competition, and all of that. They're generally not wise about all the games you could play to win as a practical founder, which depend on you and what you want out of life and your market and your timing and your competition. And are you a business founder or a technical founder? And there's all kinds of games in there. There's many, many ways to play the practical founder game and win. And literally no two are alike. That's the Practical Founders podcast is really showing, here's another way to do it. Here's another way to do it. Here's another way to do it. And, but the common denominators are, I'm going to work hard to fund it myself. Sometimes you get to revenue quickly and customer revenue funds it, but usually I got to lean in with my time and effort. And it takes longer than people want. Your average founder, kind of drinking the drugs and is young and showing up at these ecosystems looking for funding, isn't prepared to put in the years and invest the savings and through all the trials and tribulations that are doing it. And there's a little wisdom. Some practical founders are like, I would never go to VCs. I just don't want to play that game. I'm just going to bootstrap it. They wouldn't even consider it. But a lot have looked at it and said, I could see what that game is. Now that I understand it, I want to stay off the drugs. And maybe raise funding a little bit later. When you're a bigger company, you can raise funding for the right reasons and not give away the farm and do that kind of thing. So, and a lot of people are just relieved that somebody is giving them permission to do it without big funding. Because in New York and Austin and Dallas and Salt Lake City, if you go out there and say, I'm bootstrapping, they kind of look down on you.
Yeah.
because it's all
Immediately
about the
become
funding.
uninteresting. Yeah.
Yes, right.
Yeah.
It's like, oh, sorry. You know why you're
You're immediately useless.
you know why you're uninteresting is they can't profit from you. You
It's
say,
true.
gosh, I want to sell you the drugs. And you say, I'm drug free. And they say, darn it. Right. And they throw rocks at you and they say, well, you should be on the drugs. Come on. You're not cool. It's a lifestyle business. Okay. So
Yeah.
Melissa, you're more in the lifestyle business, right? Which is your main pivot vote is what I want out of life. And I'm creating this great product and getting these great customers and so forth. But there's other ways to do it. And why not have a life?
Yeah. I mean, is there a difference?
Oh my gosh. You mean when you fund something with outside funding and do it yourself? Okay. So doing it yourself, it's hard. You got to work a lot. You don't have this cheat code called, splashy cashy to do it. But when you're funded and you raise money, we raised $100 million from 50 million at a time to grow from 15 to 100 million and keep on growing to $1 billion. You're all in. It's not like they're looking at you like this isn't, a 40-hour work week. I worked weekends and holidays for 25 years in VC funded.
Sucks.
Okay.
Yeah.
So, well, I know it was a game and I'm not like I'm looking back at it, but like the game is on. The clock is ticking. You need to grow this fast and sell it to make the math work for the investors. You inherit their business model. So, and then imagine that a third of your time is managing your investors, board meetings, prepping for board meetings, raising the next round. Like the drug, infusion doesn't stop.
The other thing that founders don't know is like the reason you're saying this is because there's a zero cash day that you're trying to beat. So you're trying to grow your business, you're encouraged to spend more than you're making, and there's a zero cash day. And the reason you have to grow is because you have to raise that next round to prevent that zero cash from happening. And the closer you get to that day, the more you have to give up in order to get the next tranche of funds.
Right. If you're burning $100,000 a month, and some software companies are still doing that. By the way, that's why you raise funding. Here's the money, so you can start burning and grow faster and try things and hurry up and grow faster and all that. And so you can hurry up and get to 10 million or 100 million or whatever. So there's a burn. You're burning cash. You're spending more than you make. You wouldn't raise money expensively. So expensive to raise equity funding and then just put it in the bank off to the side. You just wouldn't do it. You would accelerate. You're using it to accelerate. So there's a burn rate. But if you can't raise the next round, that 100, and you got $1 million in the bank and you got 100,000 burn rate, like you're driving into a wall, and meaning the money's going to run out in 6 to 9 months, and then you got to get another infusion, or you have to rationalize. And like converting from this overfunded company to practical company midstream, that's like failure to the VCs. That's like we're dead. We're out. See you later.
Say founders need funding because you do need something to get this off the ground, but they don't want to go the VC route, right? What recommendations would you have for them?
Okay. The first thing is, so you couldn't do this 10 years ago, 20 years ago, but you can do it now. You've seen it. Technical people cannot quit their day job and create a product in their spare time and start getting in front of customers and kind of get to revenues. And like tech founders, the coders, a lot of them won't quit their day job until the money they're making from their business is up and running. So we've had a bunch of founders on the Practical Founders podcast that are like that. So not everybody's a coder, but that's one way to do it. And they're investing their time and they're building product and they're going to market and doing all that kind of thing. So yes, there's time as well. I mean, my first lesson is if you've got a product idea and you're not raising VC funding, don't quit your day job. Don't sell your services business. Don't, stop working to have that income, unless you're old and you got plenty of money and you can do what you want or something like that. But even then, I wouldn't say invest all your savings and, do all that kind of thing. I would scrap something to prove the concept as fast as possible. This is the lesson that almost everybody says on the Practical Founders podcast, which is, I saw this market and we headed the direction and I was working on my spare time, or I kept the service. I kept doing contract service work to pay for somebody to build the product and so forth. Almost everybody says it took longer than we thought to get to break even revenues from customer sales. And whatever that was different than what I thought it was. There was the thrashing about looking for the market and doing it. It's going to take longer than you they think to do that. So self-funding is a thing. The second thing is go prove something to the world, like customers really want to buy it, and start to sell first, and just prove that somebody will pay you for this, which is a really big step. Almost nobody does that, but you should prove that somebody will pay you for this, and get excited about it, get savvy about it, and work on some friendly, friends and family to help scrap it. Like there's a little bit of, or a lot of entitlement culture that says, well, I don't have the money. I don't want to do the work. I want to quit my day job so I can focus on this. And there should be money over here to invest. Well, none of the investors are investing in that kind of game. So whatever it takes to get to that break even customer revenue with your expenses usually means the founder's not getting paid yet. I can pay all my contractors and so forth. I have seen this 1,000 times, Melissa, and you felt this. I could feel it in your voice. A founder who's burning cash and they're running out of money and they don't know where the next money is going to come from. Their brain is survival lizard brain. Oh my God, it's on fire. I can't sleep. Like my blinders are on. I'm focused. No, I'm serious. Like it's very stressful, extremely stressful. When they hit the break-even point and hey, I'm paying myself a little bit and paying my customers, and there's a momentum. By the way, the recurring revenue is just a magic trick of the modern era. It's just a wonderful thing. When you get to that break-even point and you can keep it going and nothing's going to push you off the perch, oh my gosh, the brain opens up. Oh my gosh, you can be a person again. You could see opportunities that you can see. It's very narrowing to be desperate.
Yeah, I have a bottle of champagne just waiting there for the day that we break even. I remember we hit that for my previous company and it was like the most glorious day, like huge load off your shoulders. And like as you burn less and less every month, you feel a little bit of that. But until you really break even, that sense of being able to chill, right? Everyone's like, oh, you should chill a little bit. But I'm like, you know what? You don't look at my account.
No, there's no chill.
Don't
there's
tell
no
me
chill.
to chill.
Yeah.
Don't tell me to chill.
No, this is not
I'm the
easy.
one that can't chill.
Right.
If I chill, I won't be where I am right now. So Greg, like the thing that I love most about your content in your podcast is that you're showing the world that this is possible, right? And that practical founders are out there and not alone, right? They're just not being reported on by the media. And maybe they don't even care about that, right? And that's one of the reasons why I wanted to start this podcast, to shine light on the 99% that nobody ever hears about. So I'm curious, right? Like, why are you doing this? Is there a greater mission behind what you're doing right now?
Well, as you can see on here, I'm a longtime software guy. I've been doing this for over 30 years. And by the way, anybody who's gotten to the point you are, Melissa, you're not going back into corporate life. You tried it at SAP for a brief stint. Heck no, you're not going back.
No.
This is a great game. The software game keeps getting better. Markets are huge. Technologies are better. Going to market, the SaaS game is better and better. The software game keeps getting better and better. But here's the deal. For founders, the software game to create change in the world that improves people's lives like you're doing isn't about the funding. It's about the founders. I'm about the founders and always have been. And so it's hard, like the US healthcare system is not about the patient. Really, it's not about the patient. It's about the insurance companies. It's about the pill mills. It's about the pharmaceutical companies. It's really not about the patient. I'm just remarkably just about founders. Software companies can create massive change in the world. So like I actually have a CEO peer groups. I have 3 groups of practical founders. We meet monthly, 25 founders. I am helping them create impact in the world. So this is me just continuing to make impact in the rest. And when I'm not part of the funding industrial complex, I can recommend what's best for founders. So I just see this a huge, huge market. There's a lot of smart people in the world that should stay off the funding drugs and have a great life and solve their customers' problems and keep on going. None of this is easy. So practical founders means reasonable, but founder means crazy. There's still a bunch of crazy. Like almost nobody in your world would ever do what you're doing. You describe what you're doing and they say, I don't know anybody like that. That's kind of crazy, but you're doing it in a practical and responsible way. So this is just one of the swim lanes. My larger goal here, Melissa, but your podcast, other podcasts, and other these things popping up is if you want to an incubator, an accelerator, a business school, an MBA, You talk to people in the ecosystem, and everybody says, well, here's one swim lane called venture capital funding. And here's the reasons you would do that. And here's reasons you wouldn't. And here's how you would be successful. But here's this other way that should be the default that says stay off the drugs and scrappy fund it and get to customers. And it's about customers and employees first and the founder's life and so forth. Nobody's talking about like a door number 2. There's no alternative out there. So that's my larger mission, is that people can discover that you can build a great life, a great company, great employees. One of the possibilities that I didn't even see is that maybe you don't sell your company. Maybe you've created something with your employees and your customers and your life that's the best thing you could ever have. When practical founders sell their company, they say things like, it was the best day when I saw the money hit the bank account. It was the worst day when I was all alone without my team working on really cool stuff.
Yeah, I've heard that.
And then I say, how long did it take you to get back in the game and try to recreate what you had? And they say 6 months or 3 months, or right. We can't go play golf, I ski, but in between, podcast sessions and things like that and calls and consulting. So one of the possibilities is you don't sell your company.
Yeah.
And your employees, create some lives with your employees. A lot of great talent is coming on the market now that doesn't want the drug-infused death march that is VC funding.
And so, Greg, one last question for you as our time is up. What are some final words of wisdom that you want to leave with our listeners today who are bootstrap founders focused on driving growth and profitability?
My biggest message is it's harder than it looks. This is not like a normal thing. It's not like being a dentist. You go to school and you get grades, and you go to school and then you buy practice and you do, and it's pretty well-worn path. Startups are experiments. They're really hard. You don't know the answer. Take long. That's why not everybody can do it. It's going to take longer than you thought. And it's another reason to stay off the funding drugs. And they should just see the possibility that if you're actually that good and your product works that well and your customers love it that much, you shouldn't need a lot of funding to get it going. Mm-hmm. Funding doesn't necessarily help those kind of things. So I just think the possibility of creating impact for customers and successful software companies and happy employees, the happiest founders and the happiest employees and the happiest customers in the software game are the ones without big funding.
Absolutely. Greg, amazing conversation. How can people connect with you?
Well, I'm on LinkedIn, Greg Head at LinkedIn. They can go to practicalfounders.com, which is the main thing I'm working on. See, didn't quit my day job. I have a few things going on. Practical Founders is taking off. It may be my primary thing, right? The parlay game, one thing into another and find it. And I've been playing this game for 7 years since Infusionsoft and Practical Founders finally launched this year. So it takes a while. Practicalfounders.com. And the podcast is available wherever you find podcasts. Practical Founders Podcast. Here are stories of people who've succeeded in all the different ways, including you. We'll see your interviews there. And it's a great one.
Well, if you enjoyed this episode, don't forget to subscribe to ProfitLed and be notified of new episodes. Head over to our website, profitled.fm, to see the show notes of this episode as well. Greg, thanks again for your time. That was an awesome conversation.
It's always great to talk with you.
Thanks for listening to ProfitLed. If you enjoyed this episode, we hope you will subscribe to the ProfitLed podcast and head over to our website, profitled.fm, to see the show notes of every episode. You can also join our mailing list to be notified of new episodes or when we have interesting products and resources to share. We promise to only share things you'll actually care about. Thanks again for listening. Bye now.